Dear viewers, in this session we are going to cover question number 32 of March-June 2017 financial reporting, formerly called F7, now FR, ACCA. We are going to prepare the statement of financial position. Let's go to the required. Prepare the consolidated statement of financial position for Dargent Co. as at 31 March 20x6 for 20 marks. Let's go to the scenario. We'll first read the whole scenario, then we'll answer item by item or note by note. On 1 January 20x6, let's take note of the date. This 1 January 20x6, we are reporting as at 31 March 20x6. So it means we've got 3 months, January, February, March. So on 1 January 20x6, Dargent Co. acquired 75% of Latri Co. equity shares by means of a share exchange of 2 shares in D Co. for every 3 Latri Co. shares acquired. On that date, further consideration was also issued to the shareholders of Latri in the form of a $100 8% loan note for every 100 shares acquired in Latri Co. None of the purchase consideration nor the outstanding interest on the loan notes at 31 March 20x6 has been recorded by DCO. At the date of acquisition, the share price of DCO and Latri is $3.20 and $1.80 respectively. The summarized statements of financial position of the two companies as at 31 March 20x6 are, we are given here, non-current assets, PPE, investment in Amari at 1 April 20x5, inventory, trade receivables, bank, we are given equity shares of $1 each, retained earnings at 1 April 20x5 for the year ended 31 March 20x6. Non-current liabilities were given 8% loan notes. Current liabilities, we are given the following information is relevant. At the date of acquisition, the fair value of Latri Co.'s assets were equal to their carrying amount. However, Latri Co. operates a mine which requires to be decommissioned in 5 years' time. No provision have been made for the decommissioning costs by Latri Co. The present value discounted at 8% of the decommissioning is estimated at $4 million and will be paid 5 years from the date of acquisition, the end of the mine's life. DCO's policy is to value the non-controlling interest at fair value at the date of acquisition. Latri's share price at that date can be deemed to be representative of the fair value of the shares held by the non-controlling interest. The inventory of Latri Co. includes goods bought from DCO for $2.1 million. DCO applies a consistent markup on cost of 40% when arriving at its selling prices. On 28 March 20x6, DCO dispatched goods to Latri with a selling price of $700,000. These were not received by Latri until after the year end, and so have not been included in the above inventory at 31 March 20x6. At 31 March 20x6, DCO's records showed a receivable due from Latri Co. of $3 million. This differed to the equivalent paid in Latri Co.'s records due to the goods in transit. The intra-group reconciliation should be achieved by assuming that Latri Co. had received the goods in transit before the year end. Note number 4. The investment in Amarico represents 30% of its voting share capital, and DACO uses equity accounting to account for this investment. Amarico's profit for the year ended 31 March 20x6 was $6 million, and Amarico paid total dividends during the year ended 31 March 20x6 of 2 million. Darko has recorded its share of the dividend received from Americo in investment income and cash. All profits and losses accrue evenly throughout the year. There were no impairment losses within the group for the year ended 31 March 20x6. So now let's answer our required. Prepare the consolidated statement of financial position for Dargent Co. as of 31 March 20x6. We will first of all calculate goodwill. So we have consideration. The first consideration is the share exchange. Let's go there where we are given the notes about the share exchange. Deco acquired 75% in share exchange of 2 for every 3. So we'll simply say how much percentage was acquired. It's 75% multiplied by how much was the capital of the subsidiary, 20,000. So 75 multiplied by 20,000 multiplied by 2 out of 3 shares, then multiplied by, let's look for the share price. We have the share price of the parent as $3.20. $3.20. We get 32. But this 32 will pose a challenge, a problem when we are now in the statement of financial position. So what we are told here is the share price of the parent acquisition was $3.20. But here in the statement of financial position, the nominal value is $1. So how many shares were purchased here? It should be 75% multiplied by 20,000 multiplied by 2 shares that were issued out of 3 shares. So Deco issued 10,000 shares. So he said 10,000 multiplied by $3.20 to get 32,000. So the 10,000 will be the nominal share capital, then the difference of 22,000 will be the share premium. So it's good for us to comply with the ISS1 presentation to present the share capital and the share premium separately. So we'll split this 32 when we come to the statement of financial position. Now let's go and take another consideration. Another consideration was 8% loan for every share acquired. So how many shares were acquired? It was 25% multiplied by 20,000. So 15,000 shares were acquired. Then now Deco issued 8% loans of 100 per 100 acquired. So we'll say multiply by 100 divided by 100, we'll get the same answer. So this becomes 8% loan notes issued by the parent. Now, if the loan notes are issued, they now pose another challenge because we have to pay again. We have to pay again the interest on the loan notes issued. So the interest should be paid at 8%, but for how many months? For January, February, March, for 3 months. So we'll say 15,000 multiplied by 8% multiplied by 3 out of 12. So the 300 will be the interest or finance cost that will be paid by the parent or that will be payable by the parent, so it will be accrued because we are not told whether it was paid or not. Now let's look for another consideration. For the consideration from the parent, we are done with the consideration from the parent. Now we need the consideration from the NCI's part. We are told under paragraph 2 here that D-cost is valued with the non-controlling interest at fair value at the date of acquisition. The share price should be used. So the share price is how much for the subsidiary? It's $80. So we'll simply come here and say NCI. NCI, they have got 25% multiplied by 20,000 multiplied by $80, like that. 25% of 20,000 multiplied by $80. We get that 9,000 for the for the NCI. Then we can add all the considerations. We get 56. Now the net assets at acquisition, we start with the share capital of the subsidiary is 20,000. How much was the retained earnings at acquisition? We have got two retained earnings. We have got retained earnings at the beginning of the year of 19,000 plus the profit for the year of 8,000. As this was a mid-year acquisition, so we'll take all those profits. So we'll say retained earnings 01 April 20 x 5 is for 19,000. Then again here we will want profit on 01 January 20 x 6. That's the date of acquisition. So we have got the profit for the whole year, but this subsidiary was only acquired for 3 months. So the pre-acquisition is the 9 months. So we'll simply say 8,000 multiplied by 9 divided by 12. We get 6,000, like that. Then let's go on and see whether we've got fair value adjustments and any other adjustments that needs to go there. Under note number 1 here, we are told that there was a mine that was not recognized, the decommissioning costs that were not recognized of 4 million. So what are we going to do with this 4 million? We are going to debit the mine asset and credit the decommissioning costs as a liability, or the provision for environmental clean up. So simply say here, mine, these are now FVA. We say mine of 4 million, it's an asset. Then we say decommissioning costs. This is a provision of the same amount. But here now, when we recognize an asset, we should depreciate this asset. So we should depreciate this asset. So how much are we depreciating this asset by? Let's go to that note. We are told that the present value discounted at 8% of the decommissioning cost is estimated at 4 million and will be paid 5 years from the date of acquisition, which is the end of the mine's life. So the mine's life at acquisition is 5 years, but we need to only depreciate for 3 months up to the reporting date. So we'll simply say 4 million divided by 5 multiplied by 3 divided by 12. So the depreciation will be 200. Also, the decommissioning costs, they now pose another challenge. The decommissioning costs, we now have to, as they are a present value, we need to unwind the discount. So how do we unwind the discount? We say this multiplied by the cost of capital of 8%, and also a portion for 3 months. So we say times 3 divided by 12. Like that, we get 80 as the finance costs, like that. Then now we are ready to sum up the net assets at acquisition. Then we can now find our goodwill. Our goodwill is now 11,000. Let's carry on. We are now in note number 3. The inventory of Latrico includes 2 goods bought from Deco for 2.1 million. And this, we need to reverse here the provision for unrealized profit of 40%. But not only on this inventory, there is also in this inventory that is in transit that we also need to remove the unrealized profit on inventory. So we'll simply come here on our PAP here and say 40% divided by 140 multiplied by, here we say 2,100 plus 700, like that. So here we'll say 40 divided by 140, all multiplied by 2,800. So the provision for unrealized profit that we have calculated is 800. We need to credit inventory by 800 and debit the retained earnings of the parent by 800. Now let's carry on. At 31 March, Deco's records showed a receivable due from Latric of 3 million. The intra-group, we need to reverse the intra-group, so we need to credit the receivable. Reducing the receivable, we credit. So we need to credit the receivable of the parent by 3 million, which is 3,000. Then we need to debit the inventory with the inventory in transit. The inventory in transit is 700. Then we need to debit to reduce the payable by the difference. So the payable now will be 3,000 minus 700, which is 2.3, like that. This will help us when preparing the statement of financial position. Let's carry on. We are now in note number 4. The investment in Americo represents 30% of its voting share capital, and Dargent uses equity accounting to account for this investment. Americo's profit for the year is 6 million and paid total dividend of 2 million. So this is an associate. So simply say associate as per the account is 4.5. So come here and say as per account, we've got 4,500. We need to give it its share of profit. The share of profit becomes 30% multiplied by 6 million, which is 6,000 in 1,000. So we'll say 30 percent multiplied by 6,000, like that. Then we need to remove the share of dividend, which again is 30% multiplied by 2 million, which is 2,000. So we say 30% multiplied by 2,000. We get that. When we sum up that, we get our value at the statement of financial position. Then let's move on to, we are finished with our notes. If we are finished with our notes, we now have to calculate our retained earnings attributable to the parent and also our NCI. We can simply say our NCI at acquisition, we have calculated our NCI at acquisition here as 9,000. Now, let's have the profit as per account. The profit as per account, the parent has got 20,000 plus 16,000. So the parent has got 20,000 plus 16,000 at reporting. Then the subsidiary has 19 and 8,000. The subsidiary has got 19,000 plus 18,000, 8,000 at reporting. At acquisition now, how much is the profit for the subsidiary at acquisition? We have got the 19, this 19 plus this 6. So how much is the profit of the subsidiary at acquisition? Is 19 plus 6. We have to remove the profit at acquisition, 19,000, and also remove the 6,000, like that. What else affected the subsidiary post-acquisition? What else affected the subsidiary post-acquisition? We have got this depreciation of the mine of 200 and also the finance cost of the decommissioning of $8. So we'll say post-acquisition we have got depreciation of 200 that reduced the profit, and also the finance cost on the unwinding of 80 that becomes 280. If we sum that, we get our adjusted post-acquisition profits for the subsidiary. Then we give the parent the share of sub, which is 75% multiplied by 1720. Under the parent column, 75% multiplied by this value here. And also we give the NCI, their share, 25% multiplied by 1720. Here we'll say 25% multiplied by this value here. We can sum up the NCI. Now we can also go here, give the share of associate. The share of associate is 1,800, and also we need to reverse with this dividend that was credited to investment income of 600. What else affected the profits of the parent is the provision for unrealized profit on inventory. So we have got PAP of 800. What else also affected the profits of the parent is this 300 interest, accrued interest payment that the parent was supposed to pay. So accrued interest. So how much was the accrued interest? We calculated above here as 300. So simply say here minus 300 like that. We can now sum here and get the retained earnings of the parent as 37,390. Now we are good to go to our statement of financial position, where we've got PPE. Under PPE, what do we have? For the parent is 75,200. So we say 75,200 plus for the subsidiary 31,500. 31,500 plus the mine of 4,000 less depreciation on the mine of 200. We get that. Then we have got goodwill. The goodwill we calculated here is 11,000. We have the associate. We calculated the associate here is 5.7. Then we've got inventory. Inventory of the parent 19,400 plus inventory of the subsidiary 18,800 plus inventory in transit of 700 less the PAP of 800, like that. Then let's go to our receivables. Receivables of the parent 14,700 plus receivables of the subsidiary 12,500 plus this, we said we are going to reduce inventory of the parent by 3,000, like that. Now let's have, what do we have? Bank. The bank of the parent 1,200, of the subsidiary 600. So we say 1,200 plus 600, like that. Then we can sum everything to get the total assets, like that. Then we have our share capital. Share capital of the parent only, we have got 50,000 plus, we said here out of this 32 we'll take 10,000 to share capital and 22,000 to the share premium account. Then from there we have got retained earnings. Retained earnings, we have calculated the figure here as 37,390. Then we have got our NCI. Our NCI, we have calculated our NCI here. Then we have got our decommissioning cost. Decommissioning costs. Our decommissioning costs, it's 4,000 plus the finance cost of 80, which is 4,080. We have got 8%. Loan notes. Let's go to the parent column. We have got 5,000 plus the parent also issued 15,000 to the subsidiary, like that. Then let's go again. We have got current liabilities. Current liabilities of the parent is 24,000 plus current liabilities of the subsidiary 16,400 plus the accrued interest of 300. Then from here we can now add everything to see whether it's balancing. We have forgot here to subtract the payable here that we said we are going to debit the payable of 2.3. If we debit that payable of 2.3, our statement of financial position balances. Thank you for watching. Do not forget to subscribe to my channel.